Crocs is reporting earnings later this week, and today the stock is the third largest in my portfolio. Of course, I'm losing money on Crocs. I don't know what the earnings are going to be, if the market will like it or not. Last time I liked the earnings, Mr. Market did not like it. I don't know. Nobody knows. If anyone claims they know, they are fooling you. But there are a few things, since it is a big portion of my portfolio, that I believe I should be looking at, and today we are going to talk about these things. Number one is, of course, hey dude. This is one of the main worries of Mr. Market. A few years ago, Crocs acquired Hey Dude, and I will agree with Mr. Market that really Crocs overpaid for Hey Dude. The growth of Hey Dude decelerated over time, and now we need to see if it has stabilized or revenues of Hey Dude are still going down. I don't really know what to expect because the company has been spending money on ads for Hey Dude. Probably it is going to work. Eventually, of course, we expect that the margins of Hey Dude are going to improve because these marketing expenditures are bringing the margins of Hey Dude down. Hey Dude is still a small portion of the overall company. The main company is, of course, the Crocs brand. And for this one too, there has been a lowering of growth rate. It is not a problem if the growth of the company slows down because this is fashion, there are trends. It should not be a problem as long as the company is generating cash, and eventually they can return that cash to shareholders, which they have been doing. This is one of the companies with the best capital allocation right now. And this is something that many people don't talk about. There have been some interesting changes since the new management took over in 2017. You will see that in the beginning, it was mostly capitalized by equity. Okay, good. So they own these kiosks all around the world selling shoes. Interesting. And then you will also notice that the number of stores have been going down. So they have been closing underperforming stores to open better ones. And the ones they have been opening are leased. So they don't even own the stores, which in a way lowers the expenses. And even if it doesn't work, it is better to move on to somewhere else. The fact that Crocs have been more capitalized by debt in recent years is not something that should worry us, even though many people are saying that the debt is more than the competitors. It's not a problem. You can have a lot of debt, but if you are able to repay your debt, it's not an issue. And Crocs, with the amount of cash flow they are generating, in less than 3 years, they can repay all their debt. But of course, they're not going to do that. It's not a problem to have debt as long as you can repay it. It becomes a problem if you don't have cash flows to repay your debt. This is not the case with Crocs. They can generate a lot of cash with little capital expenditures, and they can use that cash to do other things. Most of the equity in Crocs today is goodwill from the acquisition of Hey Dude and deferred tax assets, both of which are intangibles. Over time, if these are amortized, it means the cash flows of the company are not affected, even though maybe net income will be affected. They can use this cash flow to buy back shares to repay their debt, both of which brings value to the shareholders. Today the shares are undervalued. Buying back shares is something very good, which Crocs have been doing. They have been very opportunistic with buybacks, and they have been repaying their debt. The debt is in two forms, mainly term loans, which they have been repaying, and also we have the bonds. If we look at the bonds, the yield to maturity is 6.4%. So the question we should be asking ourselves as investors, how much are we willing to pay for a premium on stocks? Because stocks are riskier, so we expect the yield to be higher compared to bonds. Usually that's 3-4%, so 6% on bonds. Let's say we expect 10% on stocks. But the earnings yield of Crocs today is near 15% with a PE ratio of 7. This is one of the most undervalued companies in the United States today. And I see no good reason why there should be such a big discount on the stocks compared to the bonds, unless the market believes that Crocs is going to default on its debt, is going to go bankrupt. And I don't see this happening. There are a few other issues with Crocs that maybe the management is going to talk about it during the conference call, or maybe not. It's not important. One of which are lawsuits. If you're interested to know what do I think about lawsuits, I will recommend you watch this video about Celsius. Have a nice day and goodbye.